In this presentation, we will take a look at the customer section, which you might call the accounts receivable section, or the income section, or the customer cycle, the accounts receivable cycle, the income or revenue cycle. Let's start figuring with Sage 50 Cloud Accounting. Here we are in our Sage 50 Cloud Accounting demo file. We're in the business status page. That's going to be our default page that we will always be starting out with. We're then going to go to the customer and sales on the left. I'm going to call this the section of the customer and sales. This is going to give our grouping of that customer section. As we saw in a prior presentation, note it's really useful to think about these things in terms of sections, and then within each section, within flowcharts. You want to think about this in terms of the flow of the activities that will typically happen per section. That'll really help you to break out this information, concentrate in on particular items within it, so that you can memorize things much faster. So here's going to be the flowchart. We have the customers and sales tab up top, and then with the customer management, which is going to give us information on particular customers on the right side. We're going to be concentrating over here with the customers and sales tab. First thing we want to do is think about the flow down below. So we're going to go down to the flow chart down below. This is going to give us an idea of the cycle that we'll be going through within the customer section. Note that each of these flow charts components basically give you a form. Most of these items are going to be forms that you can then populate. Really important to understand these forms and then think about, visualize what the effect of these forms will be on the financial statements. There are other places where we can find these data input forms. We can find them in the drop downs up top, or possibly we can put them in as a shortcut on the bottom left-hand side as well. But note that as we get into the input of the forms, they will typically have an effect on the financial statements. If you've learned financial accounting, you know that every transaction is going to have at least two accounts that are affected. Every time you do something in terms of a form, it will be supporting or creating a financial transaction. You're going to be wanting to, and we will be bouncing back and forth through the major financial statements, balance sheet, and income statement, considering the effect on it. Now, note that the flowchart, when we think about these flowcharts, we're thinking about types of things that happen every day. That's what a flowchart means. If there's something that the accounting department routinely does, such as the customer cycle, what's involved in the customer cycle, then we want to break that down to a system that is as easy as possible by creating a standardized data input form. That standardized data input form can be something that anybody can easily populate and enter, even if they don't know how it was set up or know what the effect is on the financial statements. We want to know how it was set up and the effect on the financial statements so we have a better understanding of the process as well. So if we take a look at our flowchart over here, with the customers, you may have or you may not have the quotes and proposals and then the sales orders. What almost certainly you will have typically is going to be the invoice. So let's start from the invoicing process, and then we'll go forward from here. Now, there's two kind of ways that we can think about a sale happening. We might have a sale basically happening in a type of organization. Well, there's basically three ways. Two main ways and a third way that's less common but becoming kind of more common. One is that we might do the work first, invoice the client, bill the client, and then receive a payment later. So that's one thing that might happen. You can visualize basically a law firm. You can visualize an accounting firm, possibly landscaping or something like that, where we do the work. We have to possibly count the hours, maybe count the hours of our staff that worked on particular clients maybe, then invoice those clients and send out an invoice to the clients. Then we're going to receive a payment future in the mail. That's kind of like the standard full cycle accounting process we would have. Now, some companies don't need the full process because you can imagine a situation where most of your sales are made like at the point of sale, like a restaurant or something like that. They're getting paid at that point, at the point in time that they provide the service. So in that case, then you don't need to go through accounts receivable. You're simply going to say, I got money, increase in cash in some way, shape, or form. The other side is going to be the sale at that point in time that you make the sale. So note that one you can think is more on a cash basis system, not because you just chose to do cash basis versus accrual, but because that just happens to be the type of business you're in, that you're getting money at the same point in time that you're doing the work. The third kind of thing that could happen is you can actually get paid first. And this kind of thing could happen. It's a more unusual type of business, but you consider like a concert. If you're collecting money for a concert or something, you're going to get paid before you provide the concert, and therefore you got money before you did the work or the service. Or newspapers, and it's becoming more common because this is a common kind of thing that happens in terms of applications. So if you buy an application, like a computer application, then you typically pay for it in advance. You might pay for it a year in advance, like a newspaper subscription. And then, so they would have provided the work before they give you the money. So let's consider at least the first two of these, because those are going to be the most common. One is we bill the client, like a law firm or a CPA firm, landscaping. We do the work, we bill the client. First step in the process then would be to create the invoice. So we're going to create an invoice, and then what's the invoice going to do? We're going to send that out to the customer. That's a bill to the customer. Now, note terminology here, because it can get a little bit confusing which side of the transaction you're on. When we make the invoice, it's an invoice to us according to the software, but of course to the recipient of the invoice, it's a bill, right? So according to our software. So if we were to receive an invoice, it might say invoice on it from somebody else. It says invoice, but to us it's a bill, right? To them it was an invoice. So the terminology for the software then is going to be the invoice is the thing that we are issuing for outsourcing. And if I was to receive it someone else's invoice, then that would be for us basically a bill. So that's going to be the terminology here. What's going to happen when we create the invoice? It's going to increase the accounts receivable, people owing us money, haven't got the cash yet. And it's going to increase revenue because we're recording revenue at the point in time we did the work. And the document closest to doing that here is the invoice. Even though we might have done the work before we issued the invoice, right? We had to count the amount of hours and whatnot. But that's going to be the invoice. Then if inventory is affected, it's also going to have to decrease the inventory if we're using a perpetual system at the point of the invoice. And then the other side is going to have to be cost of goods sold, and we'll have to do a sales tax as well if that's going to be a component. So the invoice has kind of a lot going on with it, even though it's a fairly basic form. We want to make sure that the invoice is set up in such a way that someone can fill out the invoice, issue the invoice, without needing to understand all that's going on with it, what the effect on the financial statements are, or how to make the invoice data input components in there. But we're going to look at those components. Then we have the finance charges. I'm not going to get into this at this point. I'm just going to say that the invoice then at some time will get received, right? We're going to then receive the invoice. So once we receive the invoice, we'll have an automatic kind of system here to receive it. And that will what will happen when we receive it, the accounts receivable will go down because the accounts receivable represents people owing us. They have now paid us. So the received payment should decrease the accounts receivable, and the other side should go into cash. Now that cash might go into directly the checking account. However, you may decide that you want to put it into like a clearing account or something other than the checking account, because when you put it into the checking account, you want to group it in the checking account in the same way that it's going to appear on the financial statements, so that you can match out your financial statements to the bank statement in the bank reconciliation. So that means once you receive the money, you might call it like on hand or in a clearing account, not yet put into the checking account, and then deposit it into the checking account in the same way in our accounting system as we expect it to be seen on the financial statements. So that's going to be the one format of it. And then the next format we could think of, well, what if we have the cash register like in the store, like a restaurant? Well, what would be the flow then? Well, then you wouldn't have this component anymore, right? This would be gone, and we would simply have the receive money at the point in time we do the work. So we're just going to do the work and receive the money at that point. That would increase the money, cash in some way, and the other side would be going to revenue, some kind of revenue account. And then again, if inventory was affected, you would also have a decrease in inventory and cost of goods sold if it was a perpetual system, and you'd have to deal with the sales tax if it was applicable at that point in time as well. And then again, if you're in a restaurant and you're collecting money like cash or some other components, you're going to have to group that together, then go to the bank. So you may not put it directly into the checking account here, but rather into a clearing account like a cash account, and then go to the bank and deposit it in the same format that you expect it to be seen on the financial statements. So that's the second way we can do that. So now once we know that flow, then we can apply that to our different industries that we're thinking about. How would that flow apply to your particular industry? And then what's going to be the effect of each of these forms on the financial statements. So we'll actually open up the financial statements, consider the effect on them for each of these components. Now, the other items in the customer section, we have the customers and sales tax. So we can set up a new customer, view and edit customers, write letters to the customer, set up a customer defaults, and view and edit contacts. We have jobs. If we have a job costing type of information, if we're like a contractor or something like that, or even a law firm or accounting firm that has kind of a job costing type of setup, we're not going to spend a whole lot on job costing. It is a specialized type of area that we might, do a future course in on. Then we have the sales tax information. So we need to set up the sales tax information to process sales tax wherever we happen to be. In the United States, then the sales tax is typically a state tax type thing. So we need to set up the sales tax for this particular region we are in. And then we have the time and expense tracking. This time and expense tracking can help us basically to apply out to the invoice, track that information, and then we can obviously generate or create our invoice with the information, the time tracking information. Then we have the customer statements down below. We can also find and the credit and refunds. So if we have to provide a refund, then like provide the information back or give someone a refund back, we can imagine first what would happen up top with the sales document, and then reversing what happened up top with the refund in terms of the effect on the financial statements. Then we have reports. We have the major reports in the customer section, which we can also find if we go to the reports drop down up top and go into the reports up top. And then we have the intelligence reporting. So these are going to be the major components of the customer cycle. We're going to break down some of the major forms and then think about the effect on the financial statements of them. That's it for now. Let's get out of here.